So welcome everyone to Money Talks. This is a series that we do periodically here at Cadence to help our community better embrace and understand the world around them, particularly as it relates to financial markets and all the industries that the financial markets in turn affect. That is a massive topic, and so we try to break it down in relatively bite-sized chunks. Today, we're going to be talking about private equity in general. We did a similar webinar for the hedge fund industry last month, and we'll be doing another webinar about the venture capital industry next month. So hope you like it. Feedback is always welcome. Let's go ahead and get started. So this is the tweet that was heard around the world a couple weeks ago from Elon Musk. He said, "I'm considering taking Tesla private at $420. Funding is secured." With that, whatever, 100 characters, that launched a huge number of debates about the pros and cons of buyouts, about the merits of taking a company private, etc. There was just an enormous amount of fallout, quite frankly, from this one little tweet. Now, if you read that tweet and you said, okay, I generally know what that means, but I don't know the specifics, well, that's what today's webinar is here for. Everything you wanted to know about private equity, but were afraid to ask. So today, what are you going to learn? You're going to learn, well, what is a private equity firm? How do they make their money? And particularly at the end, are they the scourge or the savior of capitalism? I'm going to be particularly interested to see what people think about that last one. So why am I the ones talking about this? Well, just a little bit about myself. The CEO of Cadence Translate. We've been in business for about 4 years now, serving primarily the asset management and consulting industry, as well as all of the research vendors around those industries. Personally, I worked in private equity for 4 years at a firm in the New York area called Hudson Capital Management. It was an energy private equity firm back in an era when oil was $150 a barrel. So it was an absolutely fascinating time to be working in private equity. I've also, and this is kind of a joke, but not really, the book Barbarians at the Gate is a tremendous book about the private equity industry and specifically about a deal that happened in the 80s. And if you're wondering why is it called Barbarians at the Gate, well, just sit tight because I've got a whole slide explaining that. And then on a personal note, I was working in the industry at a time when the world's biggest buyout for a company called TXU occurred. I was in the industry when the buyout happened. I was not in the industry when the collapse of it occurred a few years later, but I witnessed it secondhand because I was so fascinated how what looked to be an amazing, amazing value proposition collapsed due to faulty assumptions, which again, we'll talk about what exactly that means to have faulty assumptions shortly. So as I mentioned, for the interpreters, translators, and transcribers in attendance for this webinar, we will be providing a glossary at the end of this. And throughout my remarks, any word that you see highlighted in red is especially important and is somewhat unique. It's the type of word that might not show up in a formal Google search for private equity or Wall Street Journal article about private equity, but it's used colloquially quite often. So wanted to make sure you get access to that. So let's get started. What the heck is a private equity firm? Well, let's just take the phrase to begin, private equity. As it relates to this particular industry, just remember a couple of things. By private, we mean they invest in companies which are not publicly listed. By equity, we mean they invest in equity, not the debt that is issued by these companies. And like so much on Wall Street these days, anything that is labeled something has evolved beyond that initial definition. You get PE firms investing in public companies. You get PE firms investing in different parts of the capital structure besides equity. But you know what? The label, it's easy to remember. It sticks, private equity. But again, what is it? For the most part, it is companies who are taking their own capital that they've raised and investing it into privately held companies at the point in their capital structure where it's equity. So what I'm going to teach you is the magic, quite frankly, of taking a, for example, $500 million investment today and selling it in 5 years for that same amount. And these guys make money from that, right? How on earth can you make money if the price you pay for something is equivalent to the price you pay later? If anything, you've lost money because of the time value of money. But these private equity folks have cracked that puzzle, and I'll give you the tools behind it. So what I'm going to do now is I'm going to read the same thing, but with increasing levels of detail. So let me give you a plain English introduction to private equity. A private equity fund takes people's money and invests it in other companies. Easy to understand. They make money when the value of that investment goes up and they charge management fees. Okay, seems fair. And their investment strategies, they often focus on finding co-investors and asserting control of their companies. So that is the plain English definition of it. Let's step it up a little bit. Let me annotate this with some more detail. Now, a private equity fund raises capital from investors, and they invest it into a portfolio of privately held companies. How do private equity firms make their money? Well, they deliver a cash-on-cash return on their investment, and they charge fees based on assets under management. And finally, their investment strategies focus often on raising debt to help finance the investment, and they improve the financial and operational performance with new management teams and/or board seats. So you now have a somewhat more detailed definition of private equity, but we're not done yet. We're going to do this one more time with the industry-specific terms that you should all be familiar with, following the same structure, defining who they are, defining how they make money, and defining what their strategy is. Okay, here we go. Now, a private equity firm or a GP will often raise capital from LPs, and they will take this dry powder and invest it in LBOs, take privates, pipes, or growth equity rounds. All of those are going to be defined in a second. Don't worry about it for right now. They make money when they deliver an IRR that is in line with their asset class. And they also make money through 2 and 20 fees on their AUM. Again, definitions forthcoming. Hopefully from context, you're understanding it. Finally, their investment strategies focus on using newly issued debt to leverage the equity slug that is needed. And they also try to improve EBITDA and free cash flow through a higher performing set of managers and directors. So I've just taken you through a simple definition of what they do and added on additional detail that from context, hopefully you can start to pick it out, but you'll see we'll go into the specifics as to what these mean as we go through this. This is the slide that has the most read terms, so don't worry if you saw this and you thought, oh God, what am I getting myself into by signing up for this webinar? If I get you to remember one thing throughout this whole webinar, it's this slide. All you need to know about private equity is that they make money through hands-on operations in their businesses. That was quite frankly the appeal for me to get into this industry when I realized, okay, this isn't about just picking a good company, it's about picking and operating a good company. And even then, it's not just about picking and operating a good company, it's about the relationship dynamics and the soft skills that you need to help bring a company to its true potential. But at this point, again, I just want you to remember, they make money through hands-on operation. So let's take a step back here. Let's think about private equity versus other types of companies you might have encountered. We're going to look at, well, how do they make money? So on this slide, you can see private equity firms, as I just mentioned 3 times already, they make money through hands-on operations. And as I mentioned earlier, incredibly, mind-bogglingly, they can still make money even if the price they paid for an asset equals the price they sell it for. Or in other words, even if the asset itself doesn't exactly improve in performance, they still make money. This is in contrast to other asset classes. What you see here, mutual funds, venture capital firms, hedge funds, they all make money in very different ways from private equity firms. Either they're a very hands-off approach that just watch share prices all day. That's what a mutual fund does for the most part. They're a venture capital firm where they are hands-on in the sense that they are really trying to offer introductions and advice, but they don't really get in the weeds the way a private equity firm does. And then, I hope I'm not being too glib here, hedge funds, they simply make money by being correct about the future. Doesn't matter what they're correct on, that's what nets them money. It is very, very far from being hands-on. With the exception, and it's an important one, of so-called activist hedge funds, which we'll talk about at the end. Just know that there is a small section of the hedge fund world that does perform private equity style attempts at value creation through working with management. Okay, now let's talk about how do these guys make their money. I've said a few times that it's almost magical that you can make money from nothing or get money for nothing. So you've probably heard the term leveraged buyout or LBO. Maybe you've used it, but I'm guessing there's a fair number of people that don't really know the mechanics behind it. I admit I went all the way through my undergraduate tenure, which was in a finance-focused program. And if you'd asked me on graduation day to explain the mechanics of an LBO, I would have not been able to do it. So this is a very, very important topic that people should not feel shy about their lack of fully understanding. So let's go through it. A buyout itself, pretty simple. A few steps here, and we're going to go through these one by one. Find a company where you are very confident about its future profitability and growth. And I'm not talking about a startup where it could either go like this or it could go like this. I'm talking about a very narrow range of highly certain profitability. You then need to come up with an offer to go to the existing owners of this company and compel them to sell the firm to you. That's a lot harder than you might think. Once you own and operate that company, you need to now move the needle in the company, so to speak, meaning you need to improve its performance. You're probably not going to do it too much, and you're certainly not going to want to see a decrease in performance. And then finally, private equity firms aren't doing this because they're bored or they like to show off their savvy. They're doing it to make money. So we would always laugh whenever we did a deal because we would celebrate doing a deal. We would take ourselves out to a fancy dinner. But that's the easy part, right? It's easy to take money and give it to a company. The hard part is actually selling the company. So that's step 4. That's when the private equity firm should really celebrate, is when they found that seller. Okay, I'm going to pick this company, J. Crew. Anyone who is American or lives in America will absolutely know this brand. It sells men's and women's clothing. The figure that you see there is decked head to toe in J. Crew. And they actually went through a leveraged buyout. So you can see here in the press release about 7 years ago, they announced that they are going to be taken private by a couple of private equity firms, TPG and Leonard Green, 2 very, very prestigious private equity firms. So let's walk through how exactly this transaction came into being. So I said, you need to look for a company that you're very confident about its growth, and not just confident in general, but confident for a very specific range of profits over the next few years. So perhaps somebody was thinking about where do people shop for clothes, and they thought J. Crew has that right blend of being very loved by a target audience and being very profitable. So they are going to say, okay, let's look into J. Crew. So they will build a LBO model, a leveraged buyout model. They will use public data about how the company is performing, because remember, at this point, J. Crew is a public company. And they will say, all right, let's look at the interest rate environment out there. And let's think about if we were to finance this purchase with our money and someone else's money, what would that look like? And I'll explain that last part in a second about using someone else's money. The point here is that they have to do some analysis around publicly available data and current financing conditions. Now at this point, the deal team cares about one thing and one thing only, which is how much confidence do I have in these projections? So if you've been working with Cadence on phone calls where someone is asking about an industry, maybe they're asking very detailed questions and you've always wondered, what the heck is this person? Why are they asking so many questions? I don't get it. This is why. It's because the entire investment is dependent upon how accurate you are with your forecasts. And so unlike some of the other sectors out there, due diligence in private equity at the market level and the company level is so extremely important. So they really care about, okay, well, what are my projections saying for this company? And let's build that up a little bit, because every projection that I've ever made has been wrong, right? I've never gotten a prediction right to the first decimal place. Forecasts and projections are always wrong, but why are they so important in private equity? Well, let me tell you about the world of M&A financing, and this is why it's so important. The idea is that if I'm a private equity firm and I want to buy J. Crew, I am not going to pay for that with all of my money. I'm going to walk across the street to Goldman Sachs, and I'm going to go to my banker there, and I'm going to say, hey, I think I can buy J. Crew. I want to give you guys a great deal. You give me a loan. I'll use J. Crew's operations to pay off that loan. You're happy because I just gave you a very safe asset that's going to return your capital. I'm happy because instead of putting up my money, I only need to put down a little bit of money. And together, we're going to make a lot of money together. This often happens just like the mortgage world, where you go to a bank and you and the bank jointly finance the purchase of a home. And the key reason why this is so important is that the bank, when they create these loans, they get paid first before the equity shareholders. So when we say, why are projections so important? It's because you have to think about, all right, as soon as I put a little itty bit of debt on a company, I have to pay that debt off, right? You lose control of your company's profits the second you put debt on it, but you get a lot more upside. So think about it this way. Would you rather pay $500 million from your pocket to buy a $500 million company and you get 100% control of the future profits? Or would you pay a lot less for the company, but you only get a 50% control of future profits? This is the quintessential debate of leveraged buyouts. How much risk are you willing to take? Do you feel so confident in the performance of the company that you're willing to burden it with debt? Because then that allows the amount you need to pay to be very little, and it gives you all of the upside if they overachieve their financial performance. So going back to the J. Crew example, again, you're thinking about, are my projections accurate? How much financing do I need to get this deal done? How much risk am I comfortable with? How much debt are we going to put on this? Now, all of this has just been theoretical model building. Now you actually have to persuade the buyer to do it. So the next step in a buyout, you got to make an offer. And if this is a public company to begin with, you should look at the share price. Is it going up or is it going down? If it's going up, the rule of thumb is that you need to pay about 30% above the current share price for existing shareholders and directors to take your offer seriously. So you remember the tweet that Elon did, which started this discussion. He said, oh, I'm taking Tesla private at 420. Well, he was referring to the price per share. And Tesla at that point was trading around 320. So this was certainly a 30% premium on the existing share price. Now, alternatively, maybe the share price of a company is going down and you think, you know what, people are just waiting for this company to die. I've got a better idea. I think that if I buy this company, I can turn this around, or I spot something that no one else sees. Therefore, you have a contrarian thesis. So you need to go to the owners of this company with your contrarian thesis. And you need to say, I know something that the market doesn't. The market is beating you up day after day, but you know what? I'm not going to beat you up. I'm going to be your savior. This is somewhat rare, and I've got a funny example of it at the end. But again, as these deals come together, don't underestimate the soft skills necessary to approach an existing CEO or an existing board of directors and persuade them to sell their company. And that's what I'm pointing out here. Think about what you're doing. You're not going to someone and saying, hey, I really like your shares. Can I get a couple of your shares, right? Or, hey, you're a fast growing startup. Let me contribute to your next financing round. What you're actually saying is, hey, you've spent your whole life building or operating this company. You've surrounded it with people that you know that you've hired. Don't you think it's time that you stop working and let me buy all of your ownership and continue the legacy you've built? And who's actually going to do it? Well, not me. I'm just a deal guy. I got a bunch of MBAs that are actually going to come in here and do this. Right? That is that is not an easy conversation to have if you don't have credibility and thoughtfulness around what you're proposing. So the seriousness with which these opening discussions in a LBO are to happen are quite substantial. So think about this illustration for a second, right? You have the caveman who wields the axe, and then you have the barbarian who wields the sword and the mace. And then all of a sudden you've got the guy with the handshake and the briefcase. So what this is effectively saying is that private equity buyers and private equity firms are aggressive. They're not there to be your friend, they are warriors. They are there to conquer territory that it might see as weak. So I mentioned at the beginning of this webinar, the book Barbarians at the Gate, right? That phrase applies to private equity firms where there was a company, RJR Nabisco, that was doing perfectly fine in life. Nothing was wrong with them, that they thought at least. And then all of a sudden, all these private equity firms started saying, hey, you know what? Don't you think it's time you sell your company? Don't you think it's time you let me cash you out? And the aggressiveness with which these private equity buyers started coming to RJR Nabisco led someone, I forget who, to coin the term, who are these barbarians at the gates? And ever since then, it's really stuck. So again, if you think about what it means to go through a buyout, it is not necessarily a friendly, hey, let's all get along discussion. It can turn quite hostile and quite aggressive. Now, what operationally happens is the private equity firm will go either to the company owner directly, they'll have dinner with the CEO, or they will use an investment bank to help reach out to the prospective company. Either way, when a legitimate or a bona fide offer is made, the company's board of directors has a fiduciary duty to consider that offer. So at this point, they are going to consider proposals. Maybe it's from one private equity firm, maybe it's from two private equity firms, but often we say the proposals come from syndicates. So it's one private equity firm who says, okay, we're going to lead the deal. We've got another private equity firm to support, and we've got all these banks lined up to do the financing. So that group of people contributing money is the syndicate. So when Elon Musk did his now famous tweet about he's secured funding at $420 a share, he had in his mind a syndicate of people willing to pay that price. So let's say you're successful, right? Day one, you need to install a new strategy. And more often than not, that is accompanied by new people, new operating executives, new board members, maybe both, right? There are many variations of how you can assume control of a company. And your goal, as I mentioned, is to move the needle, not too much. One thing that is near universal, and this is a sad truth, is that it almost always does not go well. People at a company who are used to one set of owners are told very, very rapidly and with little say in the matter, oh, you've got a new set of owners. It can be quite traumatic. It can be quite emotional. Early on in my career, I was one of those very junior executives sent from the private equity firm to go to a company that we had just taken a controlling interest in. I drove my car to the company every day. And one day someone had keyed my car. Right? They had identified me as one of the guys from that private equity firm, and they let out their frustration and their anxiety quite directly, unfortunately. So very, very few people have good things to say about the opening elements of a LBO. But you work hard, you build relationships, you build trust, you align incentives, etc., and you can get there eventually, but it is not easy by any means. Specifically, you can also expect the business to reorient its mindset. If you were J. Crew, you're probably thinking, okay, I got to ship this many clothes, I need to have this many new clothing lines per year, and I need to look at my same store sales. That's all I care about. Now, a private equity buyer might come in and say, screw all of that. You just need to be really good at generating cash. And so subtle changes, such as like which KPI should your CFO look into, can end up having huge implications on the business. Whatever the old KPIs were, the new KPIs are almost inevitably focused on financial health. So at this point, the business becomes hyper-focused on cash. How much cash are you adding each month? Where are you spending that cash? And at the same time, they're positioning themselves for resale. Because with one exception, the only way that private equity firms really make money is by handing off the company again to another buyer or to public markets. Now, what does it mean for businesses to become hyper-focused on cash? Well, unprofitable projects or divisions are closed. Employee benefits might get trimmed. Suppliers might get squeezed. All of these things just feel bad. It causes stress in some of the key relationships that the company has, but it is the standard thing that private equity managers and operators will do. Keep in mind, as nice as all of this is about moving the needle and rebuilding relationships, this is a short-term engagement. The private equity firm has a narrow window to find a seller in a few years after they make the investment. Maybe not a few years, maybe more like 5 years. But the point is, they care about maximizing their return at exit. So they're going to look at certain events that might trigger when it makes sense to pursue an exit. They might just be looking at industry cyclicality. Maybe it's a construction company and everyone knows that the industry is cyclical, so buy low, sell high. Maybe a trade buyer appears. One of the companies that my old private equity firm invested in was a metering company that ended up selling to a competitor of itself. That was a trade buyer selling to someone who is a competitor in your industry. There might also simply be an opening in the IPO markets. Ask anyone who reads the Wall Street Journal regularly and you can say, are IPOs hot right now? Yes or no? There's general consensus around what defines a good IPO market. This would be great content for another webinar, so I'm going to leave it at this, but just keep that phrase in mind about an opening in the IPO markets or an opening in the IPO window. And then, sadly, the timing for a sale could simply be triggered by the threat of bankruptcy. You made an investment, it didn't work out well. You can wait a year to see if it can turn around, or you can think, you know what, this is going to go bankrupt. Let's just see what we can exit ourselves from this. So let's talk about J.Crew. How did it end up doing, right? I posted that clip that announced the buyout 7 years ago. Well, sadly, here's an analyst who said, right now, there's a crippling debt load on the company. We're talking $30 million a quarter just in interest payments. And they're saying this is so big that it makes turning around the company impossible. As a result, any effort to improve this company is rearranging deck chairs on the Titanic. This is quite tragic, really. J.Crew is a quintessential American brand. And it seems as if the private equity firms miscalculated how much debt the company could bear, or they miscalculated how fast the company could grow. So this particular story with J.Crew doesn't seem to have a happy ending, which is hopefully why you're starting to see why there's a debate in the world right now around if this is a good or bad thing for capitalism. So to help us contribute to that debate, why don't we get a little bit of facts on the table here around what the industry looks like? Are they the scourge or are they the savior of capitalism? Okay, just the numbers. $2.8 trillion of AUM in the private equity industry, according to Preqin, one of the leading data providers. $2.8 trillion, that is an insane amount of money. Now, maybe it's gone up in the last year, maybe it's gone down. The point is, this is a lot of so-called dry powder that is going to go to buying companies, turning them around, flipping them. How often does this happen? Well, in 2017, as you can see here, there is, what is this, like 6 or so per day, right? 4,000 buyouts occurred in 2017 around the world. That is a huge number and one that is going to continue to grow, right? That's 4,000 CEOs who had to decide, all right, am I the best owner of this business or should I hand over the keys? Right? It's 4,000 sets of employees that had to go through, what does it mean to have a new owner at my company? And then this is an interesting one. If you were to look at where Harvard Business School graduates end up after graduation, when I went on HBS's career services website for the most recent year, it looks like about 18% of them go to work for private equity. There's an old joke about you can tell when a industry is about to collapse when it becomes the most popular industry that HBS and GSB and Wharton grads go to. So take this for what you will. There is a lot of money out there in the private equity industry, a lot of interest. And it's probably only going to keep growing no matter what opinion you have of the sector. So let's focus on a particular person who is a real flashpoint for the sector. If you don't know who this very charismatic or very dignified speaker is, it's Mitt Romney. He is an American politician who began his career and building one of the world's foremost private equity firms, a firm in Boston called Bain Capital. And he parlayed all that success, both in financial terms and in reputational terms, to becoming a politician. He didn't succeed in becoming president of the US. He got reasonably close. But the point here is that this was the first time, at least in my life, that private equity was discussed in the media so often. People would say, Mitt Romney fires people. Mitt Romney doesn't care about people, right? He's just in it for the money. Whereas other people said, you know what, Mitt really took the time to understand our business and turned it around. Otherwise, we would have not survived. So he really became the first time that, at least in America, we had to confront this issue of private equity and are they good or are they bad for the industry? Let me present arguments on both sides, and then I'll wrap up with where I believe the industry is. And then we'll conclude reviewing some of the key terms, and then we'll open it up for questions. So now would be a good time to start ruminating as to what questions you might want to ask. Okay, private equity. Why is it a good thing for society? Well, it creates profits. There's no doubt that in general, this industry has returned money to limited partners, LPs. And a lot of people think, oh, private equity firms are enriching these Park Avenue or Silicon Valley people who are rich already. That's only partially correct. The reality is the vast majority of profits end up going to these limited partners who tend to be school endowments, teacher pension funds, police and firefighter pension funds, all of these people that are looking to grow their wealth on an institutional basis. The second thing they do that is good for society is they bring a fresh set of eyes to a company that is either dealing with its own problems, or maybe they don't think they have problems, but they actually do. A fresh set of eyes, I think in general, people would argue is a good thing in principle. And then finally, if it's a dying company, private equity steps in to rescue them. If it's a growing company, private equity steps in to help accelerate them. We didn't talk about this particular case too much, but you'll see it in the glossary under the term growth equity. That is a variant of private equity that we should be reminded is good for society. Now, let's consider the counter arguments. Why don't people like private equity? Well, there's also no doubt that there have been high-profile bankruptcies, and as a result, major job losses because of this. Some people will attribute it to the fact that it was taken over by a private equity firm. Some people won't. Doesn't matter. The reality is there have been instances where a headline shows up one day of a private equity buyout, headline shows up a year later of job losses and bankruptcies. The other reason why I think it is viewed as bad for society is this concept that financial results are literally engineered, right? This idea that, oh, I can take a $500 million purchase price, sell for that same $500 million, but I have enriched myself throughout the process, right? That has that weird factor of money for nothing. And then finally, as we saw in the Tesla case, in some cases, a take private will remove an investment opportunity from everyday investors like you and me. If you loved Tesla and they went private, you would have no opportunity to invest in them. So this is not the worst thing in the world per se, but it's something to be aware of as people say why they do or do not like private equity. Okay, so as you can probably guess, where I fall on this debate is much more that this is a savior of capitalism. In my view, private equity can step into 3 different stages of a company's life and offer benefits across all those 3 stages. If you are a dying company, a private equity firm gives you a lifeline. Doesn't mean you're going to survive, but it means you at least have a chance of surviving. If you are an emerging pre-IPO company, private equity gives you a low-cost way of growth. And I'm going to talk about an example in all these in a second. And finally, if you are a healthy company, things are going just fine. This, I would argue, is an honorable way of locking in profits. Imagine if you were a CEO who spent 30 years doing something. Doing a LBO effectively allows you to monetize all of your life's work. Or if you're an employee who has worked for a long time at a company and you have to wait for your shares to vest, right? A buyout locks in your profits right away in what I would argue is an honorable way. This is something that, at least in the Conger family household, will frequently be debated around Thanksgiving, Christmas, or any meal with wine. And what I always come back to is, okay, you always have to think about these situations and compare it to what would business as usual look like, right? It seems, private equity is evil. They bought Toys R Us and then Toys R Us went bankrupt. Screw private equity. They're a bunch of jerks. Well, ask yourself, okay, what would business as usual have looked like for Toys R Us? They still would have faced enormous pressure from Amazon. They still would have been faced with ever increasing real estate costs and labor costs. So private equity was maybe delaying the inevitable, but I would argue there was still some pretty intrinsic issues with that industry and with that company. So let's think about that in the 3 examples I just cited. I said that for a dying company, private equity provides a lifeline. About 2 months ago, I signed up for MoviePass, and that was a terrible idea because now the company is about to go bankrupt. But you know what? If a private equity firm jumped in and said, hey, I think I've got a way of turning this around, that's at least a lifeline for that company. We talked very, very briefly about so-called growth equity rounds. So that is when a company is currently private, it's trying to get to the scale where it can go public, it's too big to raise money from venture capital investors. So it looks to some of these private equity firms for these so-called growth equity rounds. At least in the more asset-heavy industries out there, construction, energy, et cetera, there's this concept of valley of death. I didn't mark it as red on here because it's not really that applicable, but the idea is there's just a certain size that a company gets to where it's really hard for them to finance growth, and private equity can step in. Lastly, think about a healthy company that things seem fine, it's been around forever, maybe all the employees and the owners want to lock in profits. I cite News Corp as an example of this, where it's at least, no matter what you might think of the politics of the Murdochs or how much they have it together up here, you can't deny that they've built an empire that is just kind of sitting there in public markets. And so for a private equity firm to say, let us take it over, we're going to put a fresh set of eyes on it, we're going to lock in profits for you and your employees, there's some merit to having that be part of capitalism. So I do hope that this was an entertaining overview of the industry. We covered what a private equity firm does, how a buyout actually works, and then we had a look into, from a societal perspective, is this something we should embrace or something we should try to restrict? So you will all have access to these slides, which go over all the key terms that were defined. And if there aren't any questions, after a few minutes, I can go through some of these and explain them because I mentioned a few of these, but I didn't necessarily define them. So you'll have 2 pages of these glossaries available to you. And in general, I do hope that you find this type of content useful. If you haven't signed up yet, at cadencetranslate.com/learn, that will allow you to get notified of future webinars that we do, such as this one. The next one, I meant to put the date on here. The next one will be later in September on the topic of venture capital firms. So really, really looking forward to continuing this journey with you all. I'm going to pause here and let people start typing up some questions, and then we will answer them. In the meantime, I'll put this glossary back up too, so if people want to start asking questions about that. So Go ahead and type your questions. We'll pause for a moment. Okay, first question is a very good one. It was asked, you emphasize that it's important for a PE firm to move the needle, but not too much. Why are PE firms not incentivized to make the company as profitable as possible? Wouldn't that result in a higher cash out? You're definitely thinking about this in the right way. They ultimately want to either extract as much cash from the business while they own it as they can. That's called a dividend recapitalization. Or they want to position the profit levels to be so high that when they go out to the market for a buyer, they're going to get credit for that increase in profitability. Now, I say not too much because if you perhaps over-invest in something, you might end up spending a lot of cash today to reap the reward 5 years from now, but maybe you think that 3 years from now is the optimal exit. So not too much in this case might be, think about the timing of your investments and don't over-invest in something that might take a while to pan out. Okay, another question was basically around careers in private equity. If you want to get into this industry, you want to approach companies, what is the right way of doing that? Phenomenal question. I started my private equity tenure from the consulting world, which is a somewhat rare jump to make. For the most part, they generally prefer to hire from investment banks. So how do you get into it? I think you ultimately have to show your passion for company building and for investing. You're not going to survive an interview with one of these companies if you don't have an investment thesis of your own, or if you can't talk thoughtfully about other companies that are out there looking to go through buyouts. Now, if you're like me and you're not from the asset management or the sell side of asset management, and you're looking to make that jump, you can consider a few things. One would be working as an operator at a private equity backed company will give you very quick access to the deal team behind it. So if there was a smaller buyout that happened and they were looking for somebody on either their strategy team or their corporate finance team, this will help you get exposure and introductions to the private equity sector. You can also think about investor relations roles at some of these private equity firms, right? All of these firms, for the most part, have big IR teams, which will give you an entry into that world of deal making and relationship building and financial engineering. So a couple of thoughts there, happy to answer more. All right. Just going through the questions here. Okay, I've seen EBITDA used as a key metric to determine the value of the company when there is an attempt to determine its value for a possible sale. Why is EBITDA used? Okay, great question. Let's just get everyone on the same page for what is EBITDA. So that refers to earnings before interest, taxes, depreciation, and amortization. It is basically the operating profit of a company before you penalize it for however much debt it has on its balance sheet. For the most part, when investors are looking at a business, they are going to value it on a multiple of its EBITDA. For years, the most common multiple has been between 10 and 12. So a company is going to say, all right, we got to work on our EBITDA because for every $1 million of EBITDA increase that we have, that is a $10 million increase to the price that someone is going to pay for the company. So EBITDA is very, very frequently used when looking at the sale price, but it is not used when you're thinking about, well, how much cash is this business generating, right? Because the I in EBITDA refers to interest payments, which, as we saw in the J. Crew case, crippled it. So that's all about EBITDA. I'm getting a message that my background is fading. Let me see if I can add some light to this here. The sun is setting in beautiful San Francisco right now. Okay, all right, oop, there we go. Hopefully that helped. Okay, next question. How long do private equity firms hold on average? Great question. It's about 5 years. A typical private equity fund, legally, it will exist for about 10 years. So they have 10 years to deploy that capital, harvest their companies, and sell it. So in any given investment, think about 5 years as the average holding period. Okay, next question. Are there cases where a public company got bought out by a private equity firm and then went public again? Well, that's a great question. And there are definitely examples of this. I'm hard pressed to think of an immediate one now. I know in the software sector, excuse me, there have been cases where this has happened. Oh, here's a good one. I bet half of you are watching this on a Dell monitor or Dell laptop. Dell is a company that went public by Michael Dell, got taken private by Silver Lake, and a lot of people think it is going to go public again. It hasn't happened yet, but a lot of people think that it will. So hopefully this gives you a sense of some of the pathways that a private equity investment can take. Okay, folks, well, we still have a few more minutes, so if there are other questions, please keep them coming in. Playing with the lighting here, having a lot of fun. If I don't get a question in the next few minutes, I can go through some of the more amusing terms in this glossary. Okay, let's get started with some of, I'm seeing some questions in the chat window as well. Let's see. How do private equity companies generate profits in between buying and selling? Okay, so again, there are a few different ways of doing this. Let's think about the best case scenario, which is I buy for an entry price of 500. I get a bunch of smart people in the company that just help its performance. So by the time I sell the company, I sell it for 800 million, right? So you just see natural growth in the company's overall value to generate profits. But I said a lot of the magic here is this concept of you can buy and sell for the same price and still make money. And the reason is because you don't pay that full price. You ask your buddies across the street to chip in most of the money, and you just take a sliver of it. And then the brilliant thing is over the course of you owning that company, you use that company, you force that company to pay off your buddy. So by the time it gets ready to sell, you now have access to so many more profits in that company, even though you only paid a tiny amount. That is how you use leverage to achieve profits, even when your entry and exit price are the same thing. Okay, the question was, can you explain again why does EBITDA and free cash flow matter but not others? All right, so this is just a pure numbers exercise, right? Private equity firms need to look at how much cash can I generate from a business? And so they're gonna look at FCF, free cash flow. How much cash is generated over a quarter or a year after deducting anything associated with debt, anything associated with new capital investments, anything associated with buying other companies. And this might allow them to say, you know what? I'm gonna buy a company, I'm gonna use its free cash flow to pay myself back, and then I don't even care how much the company sells for because I've already paid myself back. That type of logic, which does happen from time to time, that is based on using FCF, free cash flow, in order to do that. EBITDA, on the other hand, is purely because that determines what is your selling price going to look like, right? When a company buys your company, they're looking at the EBITDA. They don't care about how much cash has been generated. They're looking at EBITDA because that is the valuation multiple that a lot of the industry uses. All right. Okay, folks, well, let me define a few of these terms and then we'll wrap up. So this one is a fun one, 2 and 20, not 20 and 2, 2 and 20. This refers to the fees that private equity firms charge. Very simple. Every year, they get 2% of the assets under management and 20% of any profits they generate. So my old private equity firm, we had $1 billion AUM. So that meant every year, without fail, we could pull out, this is embarrassing, $20 million from our investors in order to finance our daily operations. But it also meant if the private equity firm generated profits, then as the GP, as the general partner, we would retain 20% of that. So 2 and 20 will often be used in a negotiation where someone will say, hey, I represent Stanford University. I've got $100 billion to invest in various private equity firms. You're coming to me offering 2 and 20. I can't get this deal done unless you do 1 and 15, meaning you only charge me 1% management fees every year and you only retain 15% of your profits. That can go in the other direction. There are some funds that are so prestigious that have so many investors desiring to get in that they say, you know what, we're 3 and 30, right? You have to give us even more fees if you want to be one of our investors. So that's a fun one. Equity slug. This is a very colorful term, which is used to refer to the amount of equity you need for a deal. So we looked at that J. Crew example, and TPG and Leonard Green were the buyers, and they financed that deal with some amount of debt and some amount of equity. For whatever reason, I don't know why, they refer to that equity piece as the equity slug. The last one here, we're running out of time, unfortunately, so I'm not going to be able to get to too many of these. So I would encourage you guys to look at the glossary when you get them in the slides. I did see one other question come in that said, PE firms invest in public companies and asset classes other than equities. Can you touch upon those businesses briefly? Great question. So think about this as you are buying convertible instruments. So you're saying, okay, J. Crew, I'm not going to buy your equity, but I'm going to give you a loan, and that loan's going to convert into equity based on some conditions, right? Or they may ask for equity along with warrant coverage. This is something not a lot of people see every day, but it's basically buy one, get one free, right? I'm going to buy a share from you in equity, and you're going to give me a promise to issue me another share in the future. So yeah, both of these, both convertibles and warrants kind of look like equity, but from a legal perspective, they are non-equity instruments. So that'd be another example of how you can see private equity firms doing things other than equity. Okay, folks, well, that concludes our session. I do hope you've learned a lot. Like I said, we are going to be doing another one of these in a couple of weeks, so look out for that shortly. Any questions, you know where to find us. My personal email is just matt@cadencetranslate.com. Hope you've learned a lot. Enjoy reading the financial papers with your newfound private equity knowledge. Thank you. Be well.